And we're going to talk about option strategies for volatile markets today. I am from Schaeffer's Investment Research. We are a research firm that is based out of Cincinnati, Ohio. We have been in the options market and trading research and newsletters since 1981. So we have now been in for 41 years in the market. And I'm going to take a quick look here at the screen share. There was a chat. All right, everybody here? All right, so we have been involved in options research and trading recommendations for retail clients and those alike for 41 years now. So we've literally been the longest research firm that we know of out there in the market that's been providing people with recommendations to trade ideas for profitable trade ideas within the options landscape. I am a CMT, so I'm a senior market strategist. Or I'm a CMT, so I'm a chartered market technician. So I specialize in technical analysis, trend following, and the likes like that. I previously was a partner at a registered investment advisory firm where I did manage retirement accounts, institutional accounts. And then I made my way over to Schaeffer's Investment Research about 4 years ago, a little bit longer now, 4.5 years ago, to really challenge myself, bring myself into the options world. It's a different beast for a lot of people, and it's hard to understand for some people. So hopefully we can make a little bit more sense of it and what we do here. And I'm a senior market strategist over there, and I couldn't have enjoyed my time better there with that firm. To kind of bridge out and tell us a little bit more about ourselves, a long time ago, our founder at Schaeffer's Investment Research developed the exceptional analysis approach that encompasses all three forms of analysis to give us an edge when trading. So we look at fundamentals, we look at technicals, and we look at sentiment. Now, when I talk about fundamentals, we're not really talking about understanding how price to earnings ratios work for the trade, because since we're options traders, we only have a certain amount of time to get in and get out of that position. And so we're looking for catalysts that change the underlying price action of the option and of that underlying security. So we're looking for things like, is there a new product that just came out? We're looking for events that could kind of jolt the price, whether that's earnings, that's a conference, so that they list something new. These are the types of things that we're looking for these big returns. Then we look at technicals, obviously. So everything from support resistance, moving averages. Some of us use some indicators. I'm not a big indicator guy, but we are looking at things like that. And then we quantify a lot of that as well, which we'll kind of get into a little bit later on here. We do quantify moving averages at times. So we take a look at okay, so this moving average has moved back to the 100-day moving average, 6 times. And out of these 6 times, what has it done 21 days later? How many times has it been positive? So we can kind of have an understanding of how price action works within that security itself. And then we look at sentiment. So we look at broad-based sentiment, whether that's investors' intelligence or the AAII data, or we bring it also down to the micro level to looking at individual securities, like looking at put call volume ratios, looking at analyst ratings. And typically we side on the contrarian part of this, right? So that's not saying that we're making contrarian bets on something that's beaten down. That's kind of more of, we're looking for contrarian sentiment within a broader trend that we can hopefully have that trend keep going for us, right? So we're looking for something that's maybe in a bullish trend and has negative sentiment, or something that's in a bearish trend that has very positive sentiment, because we believe that this gets you the most bang for your buck, especially when you're trading options, because you need these big moves and you need big wins to offset the losses that you can incur trading options. It's the only way that we kind of see it being profitable. So we look at it, and try to factor in that we really want to be positive at least 40 to 50% of the time. And to do that, you need to have 100% gains on these option contracts, because you're going to be taking 30 or 40% losses. And if you just do the math, you can still be a profitable trader with 40% loss and 100% win. As long as you're getting 40% of them correct, it's still an average portfolio gain of around 11%. So that's kind of how we do it. And let's go into the nature of volatility. So the nature of volatility, volatility has this tendency to compress, and then it leads to this expansion and vice versa. You get these impulse and consolidation factors, much like you would think about, a coiled spring, right? It's going to just release. A couple other great examples. You look for like an air in a tire. When you pop it, that coil, that air shoots out, shoots higher, or maybe drilling oil, right? You get through the pressure. Once you release that pressure in the ground, you have these, the oil comes spewing out of the ground. So that's kind of what the nature of volatility is like. And options are generally priced lowest during these consolidation phases. So those are typically the best times to play options when you're a long premium buyer. But since we are in an extremely volatile year, we've had to do some things that are different this year. So there is ways to still be a long premium buyer, and I'm going to go through those and then even show you some short premium strategies here. But let's continue on with volatility. Looking at the VIX versus the SPY, the VIX has been holding this 24-25 level. When we see moves through that, that's when we kind of get these blow-off moves here, in these bear market rallies. So we got that back in March, kind of got through that level. We got that push up into that early April level before resuming the bear market. And then we also got that again in July. So in July, we got that move down through, and then we got a continuation through about mid-August. So we're right at a critical point once again. If we fail here, we stay above this 24-25 level on the VIX, there's a good shot that we're going to probably head back to those higher ranges. But if we can get that push through, maybe we do have a longer, either bear market rally or maybe the bottom is really in. So we're not 100% sure on that. You got to play what we see in front of us, and that's kind of where we are. We're at a pivotal point. Another way to kind of track this is you can run like a 10-day rate of change on the VIX, and moves above 50 have typically been potential short-term market bottoms, but that hasn't worked very well in 2022. So this chart that I now have up here is the 63-day correlation between the S&P 500 and the VIX itself. This is another way to kind of gauge volatility and where you are. As you can see here, I have October 20 on there, February 21, August 21, January 22, and July 22. And I typically look, and I have an alert set for when the correlation becomes zero. Since these typically work in inverse fashion, when we see these correlations tighten and they get to that 0 point, you can expect that there's possibly going to be a big move happening in the near future. Now, in January and in July, we didn't fully get that, and that's kind of a broader complex that we've been seeing throughout the VIX in 2022. Most would have expected the VIX to go to 50 or something, but we never really got it. But we got moves really close, and those moves marked major kind of turning points. Now, July kind of gave you a head fake there. You did get a move higher, but it did eventually come to fruition that we did have the move lower again. So that's one way I kind of gauge it. I know a lot of people use also the 10-day correlation. That actually just did alert last week, so we are kind of seeing that actually work its way out. That sometimes gives false signals, so I don't hold my hat to it as much as the 63-day, but it's one way to kind of look at volatility, and you have to expect some false signals. So one component that we'll be talking about is implied volatility today. Implied volatility is the market's forecast of a likely movement in a security's price. And then on here, you'll also see that we have historical volatility. That's just the actual recorded volatility. So that's the statistical measure of dispersion of returns for a given security or market index over a given period of time. And traders are typically looking for, if implied volatility is over historical volatility, that those contracts might be pretty expensive, or if it's below historical volatility, IVs are, those contracts might be somewhat cheap. As you can see in the chart here, you'll see that during times of rallies, this implied volatility and the historical volatility typically have a tendency to fall. And then when we're going back into bearish type moves, implied volatility and historical volatility rise. So it presents implications for option buyers because we don't want to see implied volatility fall within our contracts. So we don't want to see the implosion. So there's a few ways that we kind of go about this. And one of the ways is looking at different term structures. So we'll look out and we'll see if there's a different term structure out there that might have cheaper options. So what is an IV term structure? For those of you that don't know, really it's just the implied volatility difference between different maturity dates. One way traders use this is, like I said, to find the cheapest priced options across that. Or you can also look for the most expensive if you're going to be a premium seller. So that's one way we do it. And then there's other strategies that we use. But let's get into, let's just talk one more topic here. This is the implied volatility rank. This is another way for us to tell how expensive these options are. Not that it's just above historical volatility or below, but where are they priced at within the last 52 weeks? And it's in this lower pane here. This is Google again from the previous two. And you'll see right now Google's priced around 54th percentile. So it's kind of median of the road right now. They're not cheap, they're not super expensive. But they're in kind of middle of the road. You can tell that typically says to me that people are a little bit indecisive, at least market makers are, of where this direction is going to go. I would say the premiums are a little bit inflated, but that's what you're going to see during bear markets. So we know now that options can be priced differently depending on maturity date, and those happen for various reasons, whether it's an event like earnings are coming up, or if we're in a bear market, or the security's falling for other various reasons. Maybe it's a sector reason. There's a peer out there that has some problems and it's falling in sympathy. So we know that options traders are battling time since contracts expire. But as an option buyer, we are also battling theta, and it operates in a non-linear fashion, which is what option buyers are trying to avoid as much as possible. That's why we're trying to get in and out of the markets as quickly as possible, or to have our intrinsic value be there. Can you explain the relationship between option expiration dates and stock price? Yeah, we will get to that. I will come back to questions here at the end. Hopefully I have some time. I can get through this a little bit quicker, so we'll definitely do that. Volatile markets, only kind of compound this effect, right? So you have implied volatility surging, and then if you get a rally, say you bought a call contract, you get a rally, but you bought it at a high implied volatility. Now you're just not battling time decay. You're also battling implied volatility imploding on you. I have a recent example myself. It happens to all of us. It was McDonald's in July, I believe. It was a McDonald's contract. I can't remember what the contract strike was, but it was probably somewhere around 200. I think that's where it's trading around right now. But we had a rally in McDonald's there. It actually went up like 10, 15 points on the underlying. But when the time came, I got to a time stop. My option contract was at break even. And why did that happen? That happened because implied volatility was imploding, plus time decay was factoring into that. So they were pulling time premium out of that contract. So those are the types of things that you have to try to avoid when you're trading options in a volatile market. So on to some of the unique things that we do at Schaeffer's. We take the volatility, we've come up with a volatility scorecard, and it's an indicator that we gauge to see how volatile a stock is. I know it's pretty cool, and sometimes we do put it on our website. I don't know if it is on there right now, but sometimes we do upload this on there so that everybody can see it for free. So what it is, it's really just it's a hypothetical straddle per stock, and we go across the whole board of the options universe. So any optional security, we do this, and then we hold them to expiration, and then so in that kind of aspect, we have multiple time frames. We'll do 5 days, we'll do 10 days, we'll do 21 days to tell us kind of how volatile that stock is over those set time periods. And then we rank them against one another as well. So we calculate all this using real call and put implieds. And then once we get to the ranking, we weight them by the average straddle return and percent positive in the IV percentage range. And that's how we get a score. So by yourself, this is definitely a huge task. But as I stated, we do this, and all of our traders get these on our desks every week so that we understand what could be volatile and what could not be volatile. So let's look at this. So here's some of the screens that we get, and here's the highest average scorecard of the last 26 weeks. So these securities have been the highest volatile securities, whether implied volatility or historical volatility has been telling this. this is based off of how a straddle is reacting. So what we're looking for is, like, again, percent positive, and then how often they've been positive, and then ranked against every optionable security within the universe. So there's plenty of names that we've been trading out there. I see new cores out there. We have VLO, Valero. So obviously you're going to see a lot of energy names in here. We've had some short positions on PayPal at times. Merck, pharmaceutical and biotechnology. That's something we've just had some winners on. I have as trade examples here later on the day. And then highest average return for these straddles is Amazon, Google, Shopify, in the last 26 weeks. So these have been some big winners. They've been moving in directions both ways, as I'll highlight a little bit later. So what's cool about this volatility scorecard is we do get this full list in our email so that we can actually kind of go through this as well and rank them and kind of sort anything that we want out. And this can also help us with selling iron condors or credit spreads or directionally buying securities. So let's go on to the next slide, and I'll show you why. Is we have these other ones that come out with the highest positive straddles due to calls or highest positive straddles due to puts. It looks like I did put the one here that's excluding oil and gas, and we did that for a reason, is because the oil and gas sector basically littered our volatility scorecard on the call side. So we were looking for things recently, how we can find maybe other types of sectors and securities that could rally, obviously, into this recent rally, because otherwise we would only have oil and gas showing up on our screeners, and that's not what you want when you kind of see these rallies that unwind, especially with inflation coming in. So names on here that I'm just seeing is DLTRs. We've played that plenty of times. Steel Dynamics is another one, along with Nucor. Steel companies have definitely been extremely volatile, produced for good gains on upside and downside. Walmart, Nucor, VG, which is a food producer. And then on the other side, we have puts that we played, or probably Spotify, Docu, and then Meta, Carvana, Dash. These are names that we've just frequently been playing this year. And then so why do we use these, straddle type of volatility scorecard for long premium trades that are directional? Well, it gets back to the underlying point. When you're playing options, you need that movement. So we typically have this little acronym that we use around the firm. It's called FAR. So we want a fast, aggressive, and in the right direction type of move when we are playing directional strategies. So that's how the volatility scorecard can help us out directionally. And then another extremely important factor when you're playing volatile markets like we've been in is open interest. For those of you who are less familiar with what open interest is, it's really simple. And I'm just going to give you a short explanation. For those of you who are very familiar with it, hold on, we'll move right through this pretty quickly. It's different than volume. Sometimes people screw that up. Volume is total traded for the day, whereas open interest is the total number of outstanding contracts, and it's the total of bought or sold, not both. So the one thing I would say is always try to remember, if you don't have something that's helping you look at open interest, is probably 90 to 99% of the time these contracts are bought to open. We do internally screen dealer and customer data. For the most part, on any given strike, it is typically, I would say, 2/3 to 90% buy to open by customers. And this is kind of how we use open interest as contrarian signals. And then just to kind of go on, conversely, you have, increasing open interest is new money that's coming into that security and then underlining. So there might be an interest in that security for some reason. And decreasing open interest is an indication that demand is leaving that security. And then finally, liquidity. It's a good way to gauge liquidity within that option contract. You never want to be caught in an option contract that doesn't have decent amount of open interest. We often call these kind of roach motels. I kind of refer to as the song of Hotel California by the Eagles when talking about it, because they'll let you check into that contract, but they're never going to let you out. The market makers, if they do let you out, you're going to get horrible fills from wide spreads, and you're not going to be able to get a good exit that you're looking for. Even if it works for you, you might not get that target that you thought you were going to get, just because they spread out that bid-ask price on you, and you're going to get a lower fill than you might have expected, or you're going to get a worse loss if it went against you, because they're going to keep that bid-ask, like I said, spread out. and you're going to fill at a lower price than you should. So you always want to know that you have liquidity in your contracts. So ways to use open interest, other than liquidity, we look at peak levels or last significant strike levels. These can often be support and resistance levels. Additionally, though, if one of those levels breaks, much like support and resistance, you can get significant move. Momentum will come into the situation or into the trade, because when you break through those levels, now the market maker that sold those contracts or bought those contracts has to basically hedge that bet. And that's how you get these delta hedge or gamma squeezes and these flush outs on the downside. And then finally, open interest volume ratios. We use those as a sentiment gauge, and there's various ways that we do it. The most basic way that most people would know is the put call volume ratio, and we'll kind of talk about those here in a little bit. But just here's an example of what we get. We get these peak call levels, so we know every optionable security that's trading near its peak call level on our desk in the morning. That way we can kind of figure out a way to possibly, come up with a trade idea around it if it's got some other trade drivers behind it, whether that's fading a peak call level or that's, playing a kind of a squeeze if it breaks above that peak call level. We know those market makers now sold those calls, so now they're going to have to buy shares of that stock to hedge their bet. So we could have a push higher in that security. Again, names in here that we've traded probably. I see Pins, I see General Motors, I see Pfizer, Pepsi, all kinds of names that we continuously play. And this is where we come up with our ideas. Same on the put side, peak put levels. You can look for them for support, or you can look for them to be breaking down. I know ASO is a great example. It actually traded right towards that peak put level, and then it had a huge pop, and now it's back lower on Target's news yesterday. But those are examples of what we're looking for those quick moves. You get this kind of support area. The market makers don't want to see those levels fail. So, a lot of times we get this action where you get this mean reversion or reversion off those major levels where we can get these big outside moves that we need for options trading. So to kind of just show an example of something that I did, I believe it was last month's weekly option countdown. This is a service that we run. It's a 1-week option contract at the beginning of the month. And basically, we're looking for 200% winners or more, because there's always the potential that these, are 100% loss. So this was Zscaler. This was something that I saw. It was breaking above its 20-day moving average. They're circled in the green. And when we got that move above that, it was kind of breaking out of this, either you can call it a wedge pattern or a flag pattern, but it found support off minus 50% year-to-date level, which is something we also use as round numbers and look at things like that. That's unique. Stocks have a tendency to want to either find that as support, or if they break down through it, you'll also see bigger moves. So we look for all these things to kind of combine together. But the big thing was the 160 October peak put was right there at 160. It was holding, it was acting as support. And then once we got that break above that 20-day moving average, we knew there was some potential. Furthermore, the buy to open 10-day put call volume ratio was 1.46. And that was priced in the 76, or that was in the 76th percentile, and it was rising. And from the history of it, when we looked at rising put call ratios in Zscaler, they had been typically very bullish, and they've had some massive upside moves off of them. So this is why we wanted to play this 1-week contract. We were able to get out of this position for that 200% gain just a few days later. We believed that 180 large call open interest level would act as a magnet, and that's exactly what it did. So it ran there. We were able to get out of the position at 200%. And as you can see, as soon as that kind of happened, it cratered. Eventually, it broke back through that peak put level going into OPEX. And then you had another huge flush out move. So that really demonstrates how these peak put levels can work. It can work as support resistance, or you can crack it and you're going to get this huge flush out move where you went from 160 to 130 within 5 days. So there's multiple ways to use these. Then we have the open interest ratio, like the put call volume ratio I was talking about. We do some other things that are a little bit unique as well. So we look at the 3-month, we call it the SWOR. And then we also have the gamma swore, which is 3 months, but we only are tracking near at the money contracts. And then we have our front month gamma swore, which is just the front month near at the money. And typically these are the ones that you really want to watch going into expiration week. And why do we look at high gamma options? It's because they're relevant for a couple of reasons. First, options with strikes near the money are generally more recently added options and convey the most recent sentiment toward a stock. A high amount of puts on a stock suggests pessimism, which we believe has bullish implications for a stock. The second reason has to do with the mechanics of market making. When a trader buys put options on a stock, the market maker who sells the puts becomes exposed to a drop in the stock price. Therefore, he shorts a certain amount of the stock as a hedge determined by the delta of the puts he sold. If the stock rises, it makes his put options less likely being in the money, and less likely he will have to pay out money at expiration. Therefore, as that stock price goes up, he covers his short position, which is a further tailwind for stock prices. And this is why we're contrarian. We'd rather be on the sides of the dealers most of the time than on the side of the buyers. Therefore, we expect, high gamma weighted swores to be a very bullish indicator for a stock. And for those of you that just don't know what gamma is, here's a quick explanation. Gamma is just the rate of change in an options delta per 1 point move in the underlying asset price. This measures convexity of the options value in relation to that underlying price of the security. So put call volume ratios is something that we kind of use a great amount at Schaeffer's Investment Research. One of the things that we do on a macro level is we take the SPX components. So this is all the securities within the S&P 500. It's not the SPY put call volume ratio. And then we measure this, we aggregate it, and we measure this to see where we're getting large market pessimism at times. Recently, we just topped out there close to 0.9. That was the second largest reading on the buy to open put call volume ratio that we have in our data set. I know that there's been higher put call volume ratios, but I'm not sure if buy to open has been higher than COVID's. I believe some of our data goes close back to the 2000s, but I don't know if we have that data in there to see there. But I know it actually, the great financial crisis, the buy to open was actually lower. So right now we're around 0.79. That means the market's still very pessimistic here, with good reason. Obviously, we are in a bear market. And the thing with this is it can stay elevated a little bit longer in bear markets, and it doesn't revert as much. But what we do is we typically look for rollovers in this as pessimism starts unwinding. We also look at this on individual securities. So the put call volume ratios, we get this sent to us just like the other screens in the morning so that we know what we're trading and we have ideas of where things are kind of sitting, so that we have an edge in our trading. So we also quantify it. So when we get signals that are over the 90th percentile in a put call volume ratio or a call put volume ratio, they come up on our screen so that we know how they've reacted. So as you can see here, AA, Alcoa, it's had an average 10-day return of minus 8.1% after its signal. And now it's only had 2 signals. That's very insignificant. So you take it with a grain of salt, but it's been positive 50% of the time, 21 days later, with an average return of 5.2% on 21 days. Whereas you look at NLY, it's a little bit more significant with 4 returns, not as great as like Pepsi or anything like that, but you can see 10-day percent positive 75% and an average 21-day return of 48.4%. Now that doesn't say we're just going to trade this immediately, even though it's got a 6.77 10-day buy to open put call ratio, because there's a chance that could have been all off of one gain. So we're going to want to look at the security in many other ways, but it's something to get this on our radars and for us to take a deeper look at this. And then conversely, we have it for, like I said, the call put volume ratio as well. Great example actually on here is Wells Fargo. That is got 5 prior signals above 90 percentile on the call put volume ratio. It's only got a 20% 10-day percent positive return, and the average 21-day return is minus 6.6%. and then the average or the percent positive on 21 days is also 20%. And as you can see today, if you pull up a chart of your own or anything, it's down today about 1% last I looked, and it was failing at its year-to-date anchored VWAP level. So there's potential there for a put trade in Wells Fargo, and that just kind of gives us on the radar. Now we want to still combine technicals and other aspects, but it kind of tells us, hey, this is something we need to look at. So option strategies for volatility. There's really kind of 5 different strategies that we like for volatile markets. We like directional at the money. It is much tougher on the call side, as I talked about the McDonald's call. So directional at the money for me, my favorite during volatile markets is on the put side, buying long puts. And there's a reason for that is we typically have implied volatility expansion, which only adds to that contract price. But if we do want to get long calls in a bear market rally, what do we typically look for? We look for deep in the money or a way to kind of protect even puts. So that's another type of strategy. Then we have straddles. This is more of a pre-volatility event. So when we were kind of rallying, the best time to put on straddles was into this rally recently, because the direction, we don't know necessarily right now if we're going to trade up to 420 or if we're going to check back to 380 or 360. My bet is that we're probably going to go somewhere between 390 and 385 right now. If you look at the trend line in the S&P 500 and some horizontal kind of support levels there. Could we break through it? Definitely. That's where a straddle will come into play. Could we, come down, test, and then break out and really kind of rip bears' faces off? Yes, and that's where a straddle also would work really well to upside momentum. Also, when you're a little bit more indecisive like that, pairs trading is a great way to do that. That's where you buy one call and one put on similar securities within the same sector. But we're looking for a breakdown of that correlation, and you might possibly hit both ways. And then also credit and debit spreads. When you are in a time period of high implied volatility, these will definitely help you, and we will cover all that. So directional at the money, strong directional conviction in the direction that you are looking to trade. As I said, in bear markets, we are looking for the beginning of a potential pullback. We don't want to get caught in implied volatility implosion on the upside for calls. You can do it. It's just very difficult. I did one recently. It was with MPC. But the thing with MPC was it's in a bull market for energy stocks. So even though we're having a broader bear market, and it believe implied volatility was ranked somewhere around the 36th percentile for that. So they weren't super cheap, but they were cheap. I mean, cheap enough for this type of market environment. And I believe we took the November 95 call, and we were targeting 120. We reached that target. We took it off on the 11.4 for a net profit of, I believe it was 136. The first half we took a little bit lower, so that second half was like 168% profit. But what are the kind of key components of this? They're in a consolidation and looking for a breakout, and we're expecting volatility expansion typically, especially when we're looking to play to the downside. So here's an example of how we look at this. This is Church and Dwight, not a very well-known name. It's on the lower end of liquidity, but it's still playable. We traded this back in August 15th. We were swing trading this, looking at a little bit further out. We were looking at the October 90 strike put. And as you can see, this green circle, this is where we traded it. This was from one of our newsletter type of products that we send out. It goes out every Sunday night. So sometimes we have to kind of anticipate that breakdown. We can't wait for a real-time alert like we do for most of our services. But I put this trade on. It was going through like a small bear flag. It looked to be rolling over. It actually went against me to begin with. But it failed at that 100-day moving average, which had been significant during the last bull market. It was honestly a stud of a moving average that you could buy CHT and it would almost go up almost every single time. So when we saw this failure here and this subsequent kind of bear flag forming, we thought, hey, this is a great idea to get involved in this. As you can see, it traded up to this 20-day moving average. That's where you got the failure, right by this 90 strike put level. And the reason why, I would say it's at the money is the closest contract is on CHD. We have $5 wide strikes. So it's the closest to at the money I could get on this. But the other factors that we had going on here, we had a 10-day call put volume ratio in the 97th percentile, and it actually surged to 9.47. So traders were extremely bullish on this. But when we look back in history, call put surges in 2022 that have been like that produced downside action within a month, leading us to believe that this was likely a little bit of a false rally into this bear flag. Our volatility scorecard was a 76. So not anything extreme, but in the upper 25th percentile. And then options were actually pretty darn cheap. They were priced in the 20th percentile. And this 90 strike call level was acting kind of as resistance. We saw it kind of here, and then it was still in place as a peak call level. So we didn't think that we would get through 90 even on a little bit of a trade against us. We thought it would fail there, and that's exactly what happened for us. We got a big move to the downside. We were targeting $82, and on this gap down, we took our profits. It was around 109%, and you can see it stopped exactly at that previous low. So that's how we're setting up our targets, because you don't know if you're going to go through that necessarily. So you want to make sure that you can hit your targets within the defined technicals as well. So directional in the money. This is where we typically can play either puts or calls in volatile markets. So we're still going to have strong directional conviction, and it's going to be momentum driven. So it will be put on during pullbacks, that are momentum kind of driven there. So you can kind of get into them and you allow price action to work more for you than the convexity of the time premium and everything. Or in the early innings of a rally. And why do we do that in the early innings of a rally versus buying at the money? I think I've already said that, plenty of times here. It's because you get this implied volatility implosion. In the money, if you're buying like a 70 delta or 75 delta or even an 80 delta, you have a little time premium baked into that. So the implied volatility implosion doesn't hurt you as much because you have this intrinsic value within the contract. So it protects you against those volatility implosions to allow you to still achieve your targets. So a recent example, the most recent one we have was a put trade. We traded it on October 27th, and we entered the contract. It was the 11-11-56 strike put on DocU here. We entered at $7.27. We took the first half off here. It's down here in this green circle, this bar right here for 104%. Then when we got the gap down, we took that, it was 11.9 for 134% on this trade. We wanted to get out of it. It was a 2-week contract. So you're looking for these opportunities. But what led us to get into this trade was a variety of factors. Yes, it's in a falling wedge, but on 10/19, Adobe reported earnings and showed slowing growth in cloud document services. We thought that DocU could possibly have some carryover of that pessimism. And then DocU also was below its previous earnings close after gapping higher. So that's kind of a red flag when you get these gap higher and then it moves back below these earnings closes. That means even though it reported decent earnings or there was maybe good guidance, investors are still very pessimistic. And that might not be showing up in other things, but it's just the price action is telling you, hey, they're still trying to sell this. It also had potential resistance at the round $50 level, at the round $10 billion market cap level, which is at 49.80. And then this 30-day moving average, since this earnings report, that's where it failed at. It kind of guided this trade lower. You'll see that it failed there in early October as well. And so we played that failure again in late October, going into early November there. And then furthermore, the 50th strike put was, or call was actually the peak call level through November standard expiration. So we knew that it could provide resistance for us there. And then the 10-day buy to open call put volume ratio was 1.22, and our volatility scorecard was 90. So these is kind of showing you how we bring all these different things that we look at in options together to make trades, and profitable trades, and most of the time that we're trying to obviously make for our clients. we still have to manage our risk and things don't always go as planned, but we try to use these to give us an edge in trading. So straddles. Straddles, basically, you're just trying to profit from volatility. You're anticipating a large move on the horizon or one that might be early innings that is already underway. We're looking for underpriced contracts relative to the potential move. This is where you're buying a call and a put of the same security and same expiration. So all you're doing, you don't really care what direction it goes in. You just want to see that this is making a big move. As I stated earlier, when you're a little bit more indecisive of what the security is going to do or the market's going to do, this is where straddles is a decent option, other than the pair trade, which we'll get to next. So our most recent straddle we put on November 4th. It was a weekly straddle, and it was the 11/11/88 contract straddle for Amazon. The entry was $5.06. We were able to exit for a total gain of 115%, and the exit price was $11.58. It was really a post-event type of trade, so implied volatility is imploded on us. Amazon, as you can see, gapped down on earnings. So once it broke this $100 kind of psychological level, we were riding the rail of the lower Bollinger Band. The jaws kind of were opening up for volatile move. So we decided to put this on to see if we could get a volatile move, either a reversion or a further breakdown. 1 week decline was 13.9%, and it was by far the most extreme move going back to 2020. So we thought there could be a reversion to price action. And then it also had a few other things going on. It was closing in on its 50% or minus 50% year-to-date level and year-over-year level, which we thought could be a pivotal level either for a bounce or for an acceleration of losses. It broke below the 1 trillion market cap. Again, nice round number. Typically, these have either holding power or you kind of see accelerations through them. And then also our volatility scorecard was a 91. And then recently, Amazon for the longest time was kind of, tight movements, right? And it was a bull market. It moved consistently higher, but it's had kind of this idea or this kind of place where it's been making large moves recently compared to in the past. So we thought, hey, it's got an opportunity to make another large move. And then the open interest also was all out of the money and to the upside. So we thought there was less of a chance for pin action. And what pin action is basically when all of a sudden your security starts going nowhere. And in a straddles case, all that does is start decaying your long premium options and forces you to take a loss on your straddle. So we didn't think there was a lot of chance for the pin action. So we took this trade and it produced a nice winner within 1 week. And then pairs trading. This is something that I do at our firm, and it's really meant for uncertain market direction. My favorite time to put on pairs trades are on bear market rallies because I'm not sure, maybe what the market's going to do. Like I said earlier, the S&P 500 could go to 4,200. It could go to 3,800. These are the times you kind of want to put them on. You have lower implied volatilities, and this allows you to profit from the volatility and allows you to capture the convexity of either one side or both sides as well. So as I said before, it's a call and a put. You have a bullish and a bearish. So you're long a call, you're long a put, and we're looking for a security that's within the same sector, maybe different industry. That's perfectly fine, but they have some correlation to them, obviously, since they're in the same sector. Couple of things I've done when I've done studies on this is the higher correlated it is, the higher percentage of wins you actually get on the pairs trade. But the less correlated it is, the larger the returns you can obtain because you will get those moves in opposite directions. So it's a unique kind of strategy. It's basically like how hedge funds go long and short, and have a long and short book. So what you're looking for is an outperformer and an underperformer that are similar. So my example today for that is Merck. We traded this on September 26th, and then we exited it on actually October 26th. So exactly 1 month later, and we took profits around 50%. I think it was like maybe 48%. And that's what we're kind of targeting. Instead of the 100% mark on pair trades, we're targeting 50%. And then we're placing our stops around 25% or 20%. So Merck, it was the December 85 call that we traded, and the Gilead was the put side of this, with the December 65 put. So drivers for Merck, we were kind of sitting around here around this 160-day moving average. We knew it had been significant in past cycles from our quantitative data on moving averages. It was trying to find support near the 2021 and the 2019 highs. It was attempting to find support around the 20% year-over-year level. Peak put was also at this 85 strike. And so we thought it was acting as support. It was a good time to take an opportunity there. And then the Schaeffer's Volatility Scorecard was a 94. And then the buy to open 50-day put call volume ratio was in the 76th percentile. So we had a target of $96 on Merck to be able to reach our targets for this trade. And as you can see, around 1026, we definitely reached our targets as it was gapping up into earnings here and rallying pretty hard. But this is why we trade pair trades, because both sides don't have to work. So Gilead, we were dead wrong on that side of it. So we didn't get a double benefit, but I think it's important to show you that, it's still a 50% return basically on a trade, even when one goes against you pretty badly. So for Gilead, we saw this as, kind of a rising wedge pattern. It was below this kind of 63 level here. And that's kind of had been resistance. We thought, hey, we could maybe get a breakdown here. If we get a breakdown through this 160-day moving average and this breakdown through this lower trend line, we could kind of play both sides. Obviously, that didn't work out. The whole healthcare sector went up, but the drivers were there, and this is why we did an impaired trade. Sometimes they don't work out. And as you can see, it kind of rallied right with Merck up into its earnings. So we took both of them off ahead of earnings. Merck was able to report. Gilead was next. We wanted to kind of get out of it for that. And as you can see, it was a good thing because Gilead absolutely skyrocketed. So then on to premium selling quickly here. We don't have a ton of time left, so we got two more to get through here quickly. Credit spreads, why do I like them in volatile markets? We have directional bias. I'm more in favor of selling puts for bear market rallies on credit spreads than selling call spreads, just because you don't get that implied volatility implosion from the call side if you're right. You do from the put side if you're going to get a little bit of a rally. And you can profit from a wide range of outcomes. You don't need this thing to rally. You just need it to go sideways or even slightly lower. And you have cap losses. And again, theta decay is your friend if you remember the chart from earlier. So this is now working in your advantage, and time premium is coming out of it every single day. So the most recent one I did on an index, I've done others on Alto recently, I believe PINS and FCX and then PDD as well. But this was IWM. We traded it on October 3rd. We sold the November 152, 150 put spread. And we were selling this. Why? Because we saw this double bottom pattern kind of forming here. 164 had been prominent support for the Russell on the IWM, on the ETF IWM. And then we were selling premium below the peak put at the 160 strike. So we wanted to kind of protect ourselves if we did get a flush below that. That way we could at least stop out at a reasonable level. But we never even reached it. We never even reached that peak put level, luckily. We got a fill for around 28 cents. So it was a good return on this for the $2 wide spread. And then, as you can see, it's going to be expiring here. This option expiration date worthless. And then finally, vertical call spreads. This is something we started doing this year. It's a new service. And this chart just really explains how a vertical call spread works. We're selling one call that's near at the money, and then we're selling a out of the money call against it. And this, while there is a negative to it and you can't let convexity run all the way, it works really well in bear markets because it has some benefits. Directional, you're still making a directional bet, but you're making it with less upfront capital, allowing smaller accounts to trade larger price securities that otherwise might have been priced out, since they are selling this contract against that long premium option that they're buying. You also have a little bit higher probability of profit from this trade structure since your break even is lower from selling that higher out of the money contract, and you need less of a move in your direction than you would for an outright long premium position. Time decay is a little bit muted in this situation because you have that long premium position, but you also sold that contract against it. So theta decay slightly offsets from the contract that you sold. So, as that works in your favor, it kind of helps you out a little bit. And additionally, stop losses are a little bit easier to manage since a big move against you works in your favor a little bit. So instead of maybe a minus 40% loss that you would have on a long premium contract, you might only be at minus 25% on the spread or 30%, and that kind of helps a little bit since that contract that you sold will decrease in value. So here's the most recent example. We had an entry on this on October 21st. On expiration of October, that's when we do these. We had the November 25-30 call spread for BTU, Peabody Energy. Our in-house volatility scorecard was 68, but it was rising, and the buy to open 50-day call volume ratio was in the 94th percentile when we entered the trade. This 80-day moving average had been extremely significant. We've had this popping up on our moving average quantitative reports, and it was holding this level. We entered the trade that Friday for around $1.40, and then on 11/7, just recently, we took profits on the first half around 150%. On this expiration Friday tomorrow, we believe it should still expire around 100%. I know our market's struggling a little bit, so still a solid overall trade for a pretty cheap contract. So thank you for your time. We'd love to chat with you about your options trading, here over at schaeffersresearch.com. We do offer a lot of free stuff. There's a lot of free news on options that you just don't see out there in the market from other providers. We do have free option education. We do have a couple free programs too that will send you daily emails of bearish and bullish watch lists where we select one of them as our stock of the day. And then we give you everything that I kind of just went through today on that. We tell you why we like it and where we think it's going to go, and we have target prices on it. And you can follow along on the portfolio. You can give us a follow on Twitter as well. Schaeffer's are at Timpane. We're always kind of posting great content there. I know I had a question here, so let's see if we can get to that really quick before we get to the next person. Can you explain the relationship between option expirations date and the stock price? Yeah, I guess the best way to explain that is the longer the expiration date, the more time premium that's going to be embedded into that option contract price. Also, the further out you go, you're gonna, so that's the best way to kind of look at it. So if you go 3 months out, and at the money contracts, could be $12. But if you're only going a month out, that same at the money contract could only be about $6 because you have 30 days less time to be able to reach your goal of reaching your target profit. So that's the best way to kind of explain the relationship between expiration date and stock prices. The other aspect to that would be is if there's events priced around those options contracts. So that's why you'll see certain contracts that will have higher implied volatilities, because you might have an earnings report around that event, or maybe in like the case of like the SPY for the S&P 500, you might have a big economic data point like CPI or a Fed decision looming. So you would have higher implied volatilities in those contracts. So that's why the price would differentiate between expiration dates. So I hope that helps everyone. That's my time for me. It's 11:55. It's 11:55, so I got to get going. Like I said, give us a follow. Come over to the website, and until then, trade them well.